Reforms rush as Sebi revises norms for fund ownership for FPIs, also approves for framework for foreign entities to tap commodity derivatives market in a bid to make commodity derivative trading more liquid and efficient. The market regulator has also approved enhancing borrowing by corporates through bond market. Let's listen in to Sebi Chairman Ajay Tyagi giving out those reforms.
The first one is KYC requirement for FPIs. This is the reference to Sebi circular of April 2018 and subsequent recommendations of Khan Committee. So they were discussed and broadly it was agreed to amend the circular and the regulations, largely in line with what Khan Committee has said, and that revised circular will be issued very shortly. Reducing the timelines for listing of issues. This, if you recall, earlier it used to be T+12, that was reduced to T+6, and now board decided to reduce it to, in principle, to T+3, and using the UPI interface, and with, of course, SBA remaining the concept as it is. So this will benefit both issuers as well as investors. The board approved the regulatory framework for permitting foreign entities which have external exposure to commodities market in India to participate in the commodity derivatives market, domestic markets in India. It defines concept of eligible foreign entities. The benefits of this obviously are discovery of current global benchmark prices for some key commodities which are traded only in Indian commodity derivatives exchanges would get strengthened by participation of foreign entities who have import-export business with India. Participation by such entities could make Indian commodity derivatives market more liquid and efficient. It may also add depth and liquidity in the month contracts.
Several big-ticket decisions were taken at the Sebi board meet which will impact corporates, investors and market participants. Let's go across to Ashwin Mohan, who attended this entire press meet. Ashwin, what were the key takeaways?
Right, before I move on to the key decisions taken at the Sebi board meet, let's first address the elephant in the room, the entire ICICI Videocon loan controversy. So we're given to understand that ICICI Bank has held informal communications with Sebi regarding a consent plea, but we are given to understand that that consent plea hasn't been officially filed as yet. So having said that, let's take a look at some of the key decisions taken at the Sebi board meet. The most crucial one was the decision to come out with a revised circular relating to KYC norms and eligibility of FPIs. This is of course related to the entire controversy around the recent circular that was issued by Sebi in April 10 that caused a lot of furor in the markets, with the FPI lobby claiming that it was restrictive and it would lead to a serious outflow of money. So the good news is that it will be a relaxed version because they're going to adopt the recommendations of the HR Khan panel. Then there was a review of the total expense ratio of mutual fund schemes, which means that the cost will go down for investors, there will be more transparency and there will be less mis-selling. Then there is also the entire aspect where the time period for listing of shares has been reduced from T+6 to T+3. The floodgates have been opened as far as the commodity derivatives markets are concerned for overseas investors. It will help India to benchmark the local commodity prices with the global commodity prices, which means that it will become a more liquid market and a more efficient market. As far as the entire consent mechanism is concerned, the Justice Dave recommendations have been accepted, which means that Sebi now has certain guiding principles based on which it will decide whether or not to entertain a consent or settlement mechanism. But willful defaulters and fugitive economic offenders, they will not be entertained. And for the first time, there's a concept of confidentiality that has also been introduced as part of the consent mechanism. Then there was a fair market panel which came up with its proposals, and in that regard, there are several amendments that have been made to the entire insider trading regime. So keep a lookout for that as well. There's also a proposal regarding Sebi to be given direct powers to intercept phone calls, but for the time being, the board has decided to send it to the government for taking an appropriate view. Back to you.
And that was Ashwin highlighting all the key decisions taken by Sebi at that board meet. And staying on with this story, the Sebi also announced they're looking to cutting expense rate for MFs. Ajay is standing by with brokerage notes on AMC on back of this news. Ajay, what are the brokerages saying?
Cheryl, well, the norms which have been changed by Sebi for the mutual fund commissions and TERs. This is a very important actually development which has happened. So most of the brokerages are saying that what happens is that the listed brokerage, in fact the entire AMC sector will be impacted because commissions will go down, costs will have to be reduced. The good part is that churning by AMCs will also reduce. Who will bear this reduction in commission? Whether it will be the distributor of mutual funds or whether it will be manufacturer, which is in this case AMCs themselves, is the question. But one understands that there will be equal pressure on both the parties. The other thing to watch out for is that the earnings for 19 and 20 will actually be impacted because of this. Not only AMC earnings, in fact we have seen MK downgrade Reliance Nippon Life AMC, other brokerages have also come out with. But the point is that not only the AMCs but even brokerages themselves get negative rub-off happens because their own overall brokerage pool will actually shrink now, as AMCs will perhaps aim for better working capital. The churn will be lesser. So this is good for consumers, the change in norms which has happened, but it is quite incrementally negative for AMCs, which will have to focus on increasing the volumes and the size of the pie because their costs are coming under pressure. And also for brokerages, they were already under pressure because of reduction in costs. So it will be interesting to see how these stocks react in trade today.